So we're going to cover task 8, 9 and 10, which will be the last 3 tasks in your exam. I don't think there's any advantage really in jump around tasks in personal tax, just do them all. So like I say, we've had 4 sessions, this last one, so this one's going to be 28 marks worth of questions, just slightly over a quarter of the exam. So task 8 is going to be a share pool. Without a, well, it's not a shadow of a doubt, it is going to be a share pool. But almost certainly, one of the things they're going to be testing in this share pool are the matching rules. So here we've got James bought some shares in Giant Limited. So we've got some transactions, and you know what you're going to have to do. You're going to have to calculate the disposal and set up the share pool. There's no way you're not going to get one without a share pool. So you look for disposals in our tax year. There will be only one. So the disposal on the 15th of May, is our disposal has sold 300 shares for £3,000. So they are going to assess the matching rules. So what's the first date we should look for when I try to identify our shares? That's right, same day. So did we purchase any? So we'll set up our matching rules. So you've got same day. Not very big. No. Then where are we going? Yeah, get that wire out of the way. So the next 30 days. So what we want to do is show the examiner that we know the matching rules. So if they all come out the pool, you still want to go through the matching rules and say, look, I did look for the ones on the same day. I did look for the ones in the next 30 days. And then you go to the pool. Now, if I hazard a guess, there's a 95% certainty you will have to use matching rules. They won't all come out the share pool. But we have got some within the next 30 days from the date of disposal. So we've identified 100 shares. So from the pool, we've got to have 200 shares. And that's our 300 that we've disposed of. So we can set up our little pro forma. So we've got our proceeds. So sold 300 shares for £3,000. So that goes there. We then look for, so we then start putting in the cost. So we've got the cost of the ones that we purchased in the future, which is going to be 100 shares at £8 each is going to be £800. And we've got another one, which is going to work in 1, which is our share pool. So we just put together our share pool. So from the pool, we need to sort of work through here. So remember, you can never take too many subtotals with this one. So you've got the number of shares and the cost. Now, that's all we really need for a share pool. And obviously the date on the left-hand side. So we've got June 13. So purchased 1,200 shares at a cost of £36,000. The next one is March 17. So we've got a rights issue. How many shares are they going to buy? That's right. So make sure you get it the right way around. So for it's a 1 for 3. So for every 3 shares they held, the right, and they always take up the rights issue, the right to buy 1 share. So what we'd effectively do is divide 1,200 by 3, gives us a figure of £400. No, 400 shares. So 400 shares at £5. I know it's £2,000, but I don't want to make myself look stupid. It is £2,000. Means we've now got 400 shares at £2,000. We've got no more transactions, so we come to our disposal. So we want to take a subtotal on a relatively straightish line. So at that point there, we have 1,600 shares with a total cost of £38,000. Everyone all right up to there? Cool. So we now need to dispose of our shares. So as we mentioned up here, not all 300 come out of here, only 200 do. So we need to take 200 out of here. So 200 from there, and we need to take a prorated cost from the share pool. We do not deduct the proceeds of whatever that would be. What is up? Enough. I'm doing instead. And so we need to take a prorated amount of that. So the way we're going to do that is a little working down here. So 200 over 1600. So the number of shares we're taking out of the pool over the number of shares in the pool multiplied by the cost of shares that are in the pool at that point in time. Here's a figure of, I mean, there are other ways you can do it. You could do 38, like Hannah said, 38,000 pounds divided by 600 gives you the price of one share, then multiplied by 200. It doesn't matter as long as they can work out. So 200 divided by 1600 times by 38,000 pounds gives a figure £4,750. Everyone happy where that has come from? Cool. So, right, we've got there, but we don't stop there. We don't want to be throwing marks away. So we need the carried forward figure of 1,400 shares. And I don't know what that is going to be. Oh, so you will lose marks if you do not have this carried forward figure on your share pool, because you'll need that in the future for the next transaction, leaving £33,250 left in the share pool. We can then transfer this 4,750 means, I don't know what it is, but it is going to be a loss. There's £3,000 less the cost of those disposed in the future, less those disposed of from the share pool, gives a loss of £2,550. What am I calling it? And that's it. And that is 8 marks. And you have 1.2 minutes per mark. Any questions on that, or what do we think to that? Do you think that is doable? Now, again, I do want to stress, if you make an error here, it's all going to be wrong. But you will not lose all the marks. They can, so do lay it out really straightforward, really simple, so they can go, right, I know what they're doing. So if you make an error with your subtotals, it's not fine, obviously. But if you make an error with your subtotals, they go, all right, they've made an addition error. It's easily done, happens to best of us. But there's going to be way more marks available for that than there is for adding up two numbers. So if you add up the two numbers wrong, as long as they can see where you got, say, for example, we added this up to 37,000. If in here you stuck 37,000 in, they're like, all right, yeah, I did it all up, but they clearly know how to prorate it. They know the matching rules and things like that. They're going to give you lots of marks. So it just needs to be clear as to where you got your figures from. So lots of subtotals. Cannot stress it enough in a tax share pool, subtotals. And for those of you going on to do business tax, it makes even more sense in business tax. Cool. Any questions on that share pool? Because it is going to be in your exam. It is not one of those things that might come up or might not. It is. Yeah, good question, Victor. So if it was a 2-for-1 rights issue in this situation, we would have got 2,400 shares for whatever they cost, rather than a 1-for-2. Watch out for that. Don't always assume it's a 1 for something. I mean, it normally is, but don't assume it. So if it's a 2-for-1, it's 2 shares for every 1 that you hold. So the first number in your ratio is the one of the number of shares you are getting in addition, based on your existing shareholding. Like I say, again, it is human marked, so you need to make it straightforward, and you will get a grid like this with no pro forma. So you need to be comfortable with how you set it out. Give yourself plenty of space, because you don't want to be redoing it because you run out of space. Now, normally you've got plenty of space. In fact, in the sample assessment, just say you have more space than you need, but don't be having to like redo things because it doesn't fit nicely in it. And always try and reference your working. Cool. Right. Task 9, capital gains tax relief. So this question here is really, really typical for the sort of thing that they are getting at, because they're getting at it for one reason. So we're not looking to see what their gain or tax is in this question. We're looking at what her losses carried forward will be into 22-23, and we're getting at something for one reason, which we'll come to in a second. So Naomi sold a desk for £33,200. Originally cost £12,500. So we've got £33,200. Take off the cost of 12,500, means we've got a gain 33,200 actually minus 12,550. Here's a figure of 20,700. So right there. Now she's also got current year losses. What are we going to do with that? Yeah, there is no option here. She has to take her current year losses off that gain. No choice. So that will come off at a figure of £2,250. It means she now has 2,250, a gain of £18,450. So the next bit is we have losses brought forward. What can we do here? This is the whole point of the question. Why is it taken like this? Kind of. You're on the right lines. That's exactly right. What we want to do is leave her with taxable gains. Sorry, no, not taxable. Chargeable gains of £12,300. And then what we can do is take off the annual exempt amount of £12,300, which means she has then taxable gains of nil. So the bit we're looking for is the balancing figure. So we want to use losses brought forward. So what does that give us a figure of? 18,050. We want to leave £12,300. Exactly right. So we need to use, let's brought forward, £6,150. Does everyone see why we're only using the £6,150 of losses brought forward rather than the full, well, not wouldn't use it all, but all of the, more of the 53,200. So if we use 6,150, that leaves us with 12,300 of that. And then we use the annual exempt amount of 12,300. So the 12,300 is what we are left with here if we use £6,150. And then once we leave ourselves with chargeable gains of 12,300, we can take off the AE to give us taxable gains. And if we've got exactly the same amount of chargeable gains as we do have as the AE is completely fully utilized to bring down our taxable gains to nil. So we won't pay tax, but use as little as possible of the losses brought forward, because the losses brought forward are useful. You can use them to save tax. If we used £18,450 worth of losses brought forward, we would still end up with nil tax, but we'd use more losses than we need to, because with the AE, you use it or lose it. So if we were to bring that, use all 18,450, we wouldn't have used our annual exempt amount for this year, and we've lost it, and we've lost some gains. Yeah, that's exactly right, Darren. So we haven't got a choice with this. We couldn't say here, no, we're not going to use them. We're going to use our losses brought forward. You have to offset a current year loss against a current year gain, even if it would have been covered by the AE, or even if you don't want to, you haven't got a choice. But with losses brought forward, you can restrict the amount that you use. So of the 53,200, we only used 6,150. meaning that we have another 53,200 minus 6150, 47,050, which I think a couple of you got anyway, of losses carried forward. So you'll often see questions where it's not worried about the gain or anything like that. It's more worried about what is lost brought forward. So it knows you know that you can restrict your losses brought forward. No, so the way you do it is, well, you are using your AE. It is coming off here, but you're sort of almost working backwards of, we want to leave ourselves with £12,300 chargeable gains, because that's when we're covered by the AE. And then, so what's the difference between our gains after the current year loss and the 12,300 as chargeable gains? And then the difference is the amount of losses brought forward you need to use. So it won't expressly tell you to use that rule. It will just say, what will her losses be brought forward? Does everyone follow that? Right, any questions? It's going to scribble this because we're going to move on to PPR, which, who likes PPR? No, I don't like PPR either. I hate PPR, really, really do. Let's start. So, I mean, it's a case of just work slowly through it. It is really frustrating and it's annoying. Yeah, it's not knowing the rules. Knowing the rules isn't too bad. It's miscounting. So you won't get, you will get a scrap bit of paper, but for the purposes of this, I'm going to do it next to the question. You'll obviously have to do it on a scrap bit of paper on your desk. But you want to set it up. You do not be taking shortcuts with PPR. Don't be thinking, I'll do it in my head or scribble some notes out. It really is worth doing properly, because if you don't, it only takes one slip and you are out. And it's not a human mark thing where you'll get an own figure. It is automatically marked. So it's like, is this figure here right? It's right. You get the marks. If it's wrong, you don't get any of the marks. So it is pretty brutal when it comes to marking. So it is not the type of question you want to be rushing and taking it, not setting it out properly, because it just what makes what is already a tricky question even trickier. So I'm going to set it up. So you've got 3 columns. So you need the ownership, then you need deemed an actual occupation, and then you need what I'm going to call it unoccupied. Doesn't really matter. That's your workings. You just got to know what it means. It's not, you won't get a grid or anything like that. So the first bit is he lived in the property. So that's pretty straightforward. And also it's a good thing that it sets off that period of ownership for various rules. So he lived in the property from the 1st of January to the 30th of June. Now, for any of you who weren't in my live tax class, I cannot stress it enough, use your fingers, because the 1st of January to the 30th of June is not the same number of months as the 31st of January to the 30th of June. So we're going to have all of January, all of February, all of March, all of April, all of May, all of June. Count your fingers. You might think you look daft, but it doesn't matter. You don't lose in marks. And no one cares. So we've got 6 months. He actually lived in the property and obviously owned it. He then went traveling. But the great thing is, he then moved back into the property. So we can then claim various rules. Now, remember the PPR rules, other than the last 9 months, they need to be preceded and followed by actual occupation at some point in time. It doesn't have to be direct. So this person's gone traveling, not been to work or anything like that. What rule can we claim here when he goes traveling? Yeah, that's exactly right. So you can have, if he's not employed or self-employed, 3 years for any reason. Now that is not 3 years for any reason, come back, go away, another 3 years for any reason. It is for the lifetime of that property. So if you use 2 years for any reason, come back and go away for another 2 years, you can only have another year, which is 3 years for the lifetime of the property. So we're going to claim 3 years for any reason. Now, we need to figure out what time period it is. So I always like to think is when would be the following, when would be one complete year? So if you go from the 1st of July 2007, it would be 30th of June 2008, 30th of June 2009, 2010, 2011, 30th of June 2012, which is exactly what it is. So that is 5 years. So 5 12s are 60. So total period of ownership, 60 months, but you can only have 36 months for any reason. There was no work or anything like that, meaning 24 months would be deemed to be unoccupied. Does everyone follow that? Cool. Next one, he's moved back into the property. So we need, this is obviously going to be actual occupation. We just need to figure it out. So 1st of July 2012, a full year would be 30th of June 2013, 30th of June 2014. We don't get to 30th of June 2015. So it's 2 years, then July, August, September, October, November, December. So 2 years, 6 months. So that's 2.5 years. So 30 months. And he's actually in the property. Exactly right, Marta. He then was abroad for self-employment purposes. How many years can you have when self-employed abroad under PPR? That's right. So self-employment, whether it's in the UK or in abroad, is limited to 4 months. If he's employed abroad, what would be the limit? That's right. There is no limit when you are employed abroad, because there is no, you get less say with that. Anyway, so he was a self-employed, so you can only have up to 4 years. I probably don't need that. So what have we got? So we got from January 15, so a year after that would be 31st December 15, 31st December 16, 17, 18. Actually, he does hit the very limit. So that's going to be 48 months, but he's going to be deemed to be in the UK because he's employed. Another month after, and that wouldn't be applicable. And also should say, we'd only get that because we know he's moved back into the property. Everyone all right up to there? So euphemism for a coffee break. Cool. Right. Everyone's still with me. Gotta love PPR. So he then moved back in property on 1st of January 2019, 30th of June. So a year after that would be 31st of December 2019. We don't get to 31st December 2020, so it's 1 year and it is 6 months. So it's going to be 18 months. I don't want that. 18 months actually living in the property with that. He then moved out. So what's the last PPR relief we can claim? That's right. That's right. So if you've lived in the property at any point, the last 9 months are deemed to be occupied, because that is the period that sort of say it takes how long to sell a house. It doesn't have to be preceded and followed by actual occupation, because obviously you're not going to move back in once you've sold it. But as long as you have lived in this home at some point in time, the last 9 months are deemed to be PPR. So he's moved into a second home. Everything else within this 9 months is going to be chargeable. So how many months is this going to be? 1st of July 2020, so it's going to be 30th of June 21. We don't get to 30th of June 20, so it's 1 year and, well, it is 6 months. So there's 18 months in total. So 9 we're going to claim for the last 9 months of ownership, and then the other 9 are going to be unoccupied. Is there any periods there that anyone wants me to go over? Cool. Right, let's add this up. So 24 plus 9, so 33 months are going to be unoccupied. Then we've got 6 plus 36 plus 30 plus 48 plus 18 plus 9. So 147 months are deemed to be or were actually occupied. And then the last bit, if you really want to be, double check, rather than say, well, if 147 is occupied, 33 aren't occupied, therefore that's got to be, what's that, 150, 180 will be total period of ownership, which we do need. It is good practice to add up your column down here, and all things being well, they should add up to the same figure. If they don't, you've got an error somewhere. Which it does. And another thing you can do, you get your pen to work, is you could do a separate calculation if you've got lots of time, and do a separate calculation just going from that date there to that date there. Obviously, there's a lot of fingers involved, but again, that should come back to 180 months. If it does, anyway, I'm not going to do it, but it is 180 months. So all we've done so far in our PPR calculation is calculate the period of occupation and the period of non-occupation. So the total period of ownership is 118 months, and then the period of actual or deemed residence is 147. We've then been asked to calculate the chargeable gain on the house. So the first thing to do is put our proceeds, which was 850. All right, £850,000. So in a PPR calculation, the first thing we do is calculate the gain as normal. We then take off the cost, which was £80,000. My word, they've made a bit of a profit on that, haven't they? Gives a gain of 770. Do that in my head. So the next thing we need to do is calculate our PPR, which comes off here. So PPR, I mean, you won't need to reference the working because you won't be, no one will be seeing your figures, but it is good practice. So working one. So what we do with PPR, it's not based on the proceeds, and it's not the amount of taxable, it is an amount that we take off the gain to come to the chargeable gain. And it is calculated as the gain, the 770, multiplied by the period of deemed or actual occupation, which was 147, over the total period of ownership, which I can't remember was 180. So as you can see here, as if there's more of the period of ownership you were actually there or deemed to be there, your PPR would be greater, and the less you're there, your PPR would be less. So we get 770, 1, 2, 3, divided by 180. Now don't round it, leave it in your calculator, multiply by 147, gives a figure of £628,833. Everyone happy with that? So we can take that off. 833 gives us 770,123. We're getting there, minus 68833 gives us a gain of 141,167. What did you think to that? Is anyone suddenly thinking, my word, I love PPR, it's amazing, or not? No. I mean, the rules are not too bad, but it's just a nightmare. I mean, I would say they are a little bit forgiving in the fact that if you get that wrong, it's wrong. If you get that wrong, it's wrong, but it will own figure into that figure. So it's not everything. Yeah, I'm trying to start making sense. It's I do it now. Even when I write them, I'm counting my fingers because you do not want to be losing marks for getting the number of months wrong between two dates rather than knowing the rules. So counting the months in terms of adding them up or how I measure it. So the way I do it, for example, let's do the short one and we'll do a long one. 1st of January 2007 to 30th June 2007 is January, February, March, April, May, June. Count your fingers. Then if you've got a long one, say for example, this one here, you're going from 1st of July 12 to the 31st of December 14. I always go, when would we complete 1 year? So the 1st of July 2012, when we complete 1 year, would be 30th of June 2013, 30th of June 2014. Now we don't get to 30th of June 2015. So we've got 2 years. Now we need to work out from the 30th of June 2014, how many months have we got? So we've got July, August, September, October, November, December. Is it in the reference material? Off the top of my head, I don't think it is, but if I'm bringing it up, it is here. I don't think it is, to be honest. No, everyone sort of agrees with me. Yeah, it's not in the reference. So you need to know overseas any period whilst employed, 4 years for self-employed. What is it for employed in the UK? Whilst I'm here. Anyone? No, employed in the UK, I should say. Not employed outside the UK. Anyone? What are we saying for employed within the UK? Right, we've got a 50-50 split between 4 and 3. It's no limit if you're overseas because you have less say in where you go. It's less say in where you work with employed, whereas you're self-employed, you've got more say. Like if you want to work in Dubai, you choose to work in Dubai. Whereas with employed, it's basically your boss goes, right, you need to go and work in Dubai or you lose your job. You're like, oh, right, I'll do with that. And some places, I think, went for, North Korea. I don't think I'll upset anyone for saying North Korea is probably the place where you don't want to live. You wouldn't buy a house up there. Whereas if you're in the UK, it tends to say, look, you've been moved to the Manchester office. And so by now, you should have bought a house. Manchester's not an awful place like North Korea. But employed is 4 years. A bit like self-employed. Anyway, right. Any questions on PPR before we move on? Cool. Right. So this one here is, again, a very typical question. We've got a gain of £40,100. It is a chargeable gain, and there is her income of £29,800. So the key point, well, not the key point, but one of the things you need to look out for is this figure here. So if it gives you chargeable gains, what does that mean? What do you need to look out for? What do you need to do? Yeah, that's right. So if it's chargeable, that is before the deduction of the personal allowance. Whereas if it's given you taxable gains, that is after the deduction of the personal allowance. So don't take it off again. They may give you both. So you need to know, you need to watch out for that word. So here, chargeable gains, we need to take off the personal allowance. No, sorry, annual exempt amount. So she's got £40,100 of gains. Take off the annual exempt amount, AE, gives a figure of, where's it gone? 40,100 minus 12,300, figure of 27,000. Oh, no, that would be down here, 27,800, which would be taxable. And that'd be 12,300 to come off. So now we've got taxable gains, we can then tax it. She has other income after personal allowance of 21 in 21-22 of £29,800. So how much of a basic rate band have we got left? Yeah, Helen's right. So of the 37,700, I'm assuming Helen's right, I haven't worked it out yet, but it seems to be conclusive, 37,700, she's used £29,800. So £29,800, take that off, gives us 7,900. So of the first £7,900 of her taxable gains is going to be taxed at 10%. Oh, I've done it that way around. Which at 10% gives us obviously £790. So of the 27,800, we've now taxed 7,900, leaves us with minus 7,900 gains of, that's right, 19,900, which is going to be taxed at what rate? That's right. So at the higher rate for capital gains, which, and there is no additional higher rate for anything like that, is at 20%. Gives a figure of 3,980 plus the 790 that we've already done. Gives a figure of £4,770 of a total capital gains tax bill. Which, whilst you are here, when would that need paying? So it's a 21-22 tax year. That's right. It would be payable, Darren's exactly right, 31st of January 23. So that's my first question. My second question, Darren's ruined. Very good question anyway, Darren. So this is just a charge, but it doesn't tell us what it is. If it, however, had says residential property, it would have been taxed at the higher rate of 18% and 28% because the government wants to make owning second homes and buy-to-lets not as attractive as it used to be. But it will have to tell you it is a residential home, and it will say things like a holiday home, a second home, a home they've never lived in. It will not tell you to use the 18 and 28% rates, and they are not given to you in the reference material as well. So the 10 and 20 are, but the 18 and 28 are not. But it will have to tell you it's a residential property, but it will not say, this is a residential property. This person's never lived in, therefore you've got to use his rates. It'll be things like owns a second holiday, owns a holiday home or something like that. Cool. Any questions on capital gains tax before we move on to everyone's favourite subject, inheritance tax? Isn't it? Right, inheritance tax. Before we get started, what do people think about inheritance tax? Criminal. I was meaning in terms of difficulty in the exam, but yeah, it is criminal, and you know, spend it all. You do not want to be losing. Well, I won't give the percentage away because that's one of the questions. But a vast chunk of your wealth that you've earned, really, you know, spent ages earning, and then just lose it all. Really. However, inheritance tax on Q22 is a lot more straightforward than what it was on AQ 2016. A lot more. There's literally one calculation that you may need to do, which is calculating the amount of nil rate band that someone has not used when they died and transferred to their partner, and that is it. There's no other calculations you need to do. There's lots of true, false, and drag and drop kind of things. So, speaking of which, this is what we've got. First one here, true, false. So the first one, the annual exemption can be carried back for 1 year, but must be used after the annual exemption for that year. Do we think this is true or false? Yeah, this is actually false, because the reason being is that younger exemption, unlike the AE for capital gains or personal allowance, is not a case of use it or lose it, but it can only go forward 1 year. So if you've not used your AE last year, you can have it this year, but you must use this year's first. Then you can claim last year's. What about the next one? Michel is domiciled in France, and he owns a house in France, but he also owns a yacht, which is moored in the UK. Would he be liable to IHT on the yacht, but not the house? I think it's true or false. Anyone? That's right, it is true. So where you're domiciled is quite important for inheritance tax. So if you're not domiciled in the UK, your UK assets will be subject to inheritance tax, but none of your overseas assets. Whereas if you are domiciled in the UK, both your UK and overseas assets will be subject to UK inheritance tax, and well, you might pay overseas inheritance tax as well. And it just depends on the country whether there's a tax agreement in place or not, but don't worry about that. Basically, all you need to know is if you are UK domiciled, you pay inheritance tax on all your worldwide assets, whereas if you're not domiciled in the UK, the government will only take inheritance tax on your UK assets, should we say. Cool. Right, we've got some link the boxes. So we've got, and one of them's going to be an exempt transfer, one's going to be a CLT, and one's going to be a pet. Cool. So a gift of £30,000 to the transferor's daughter on her wedding day. Do we think this is an exempt transfer, a CLT, or a pet? That's right. It is a pet, because you can give your daughter or son up to £5,000, which is in the reference deal, on their wedding day, and that will be exempt. That first £5,000 is never going to be subject to inheritance tax. However, if you were to die within 7 years of her wedding, the excess, the £25,000, will then be subject to death tax and get a whopping great big tax bill. Let's not say the percentage because we're coming to that. But if you do live 7 years after the date of the wedding, you get it. It's not going to ever be subject to inheritance tax, so it's fine. So it's potentially exempt. It just depends on how long you live. The next one, a gift of a historical artifact worth £20,000 to a local museum. Yeah, that is exempt. So if you give something of national significance to charity and things like that, it is exempt. So that's definitely never going to be subject to inheritance tax, because that'd be a bit unfair. It's not like you've sold it, got any money, you've given it away, you've given it for good causes, to charities, and it's for the national interest, and so that is going to be exempt. And then the last one, by the law of averages, is going to be a CLT, but it is because it is a trust. Whenever you see trust, it is a CLT. When you see a CLT, it's a trust. They are the only two things that relate to a CLT. It's a trust, and a CLT is a trust, and a trust is a CLT. Really, there's not much to say about it. So if you see money going into a trust, it is definitely a CLT, and they will definitely have to pay lifetime tax on it, but they may well be subject to death tax, which I hope I'm just giving away the next question. Right, next one. What do we think of A, B, C? If charitable life transfer within 7 years date of death, we subject to both lifetime tax and death tax. So when it goes into trust, you are all right. It will be subject to lifetime tax. However, if you then die within 7 years of putting that money into trust, it is within that 7-year death tax window. It gets pulled into the death estate, and it is subject to death tax. However, what would you do with the lifetime tax to make it not quite so expensive. And what would happen if you've got a trust that's now suddenly subject to death tax? You might need to know what you do, but you never need to do the calculation. I'll give you that. What actually happens is you would calculate the death tax at a certain rate, and then you would then calculate taper relief, which is in the reference material, and then that would be the death tax. But then you can take off any lifetime tax paid. And if the lifetime tax, because the taper relief is actually greater than the death tax, you would reduce your death tax bill down to 0, but you would not get a refund. It would only come off any potential death tax bill. In regards to taper relief, again, you will not have to do any calculations. I think as we saw in one of the live classes, it will basically be this person died on this date. What would be the taper relief on this transaction? And you'd have to just work out how many complete years had passed between the transaction, probably a pet maybe, and the date of death, and then you just go and look it up and say it's 60%. You won't have to do any calculations. Lastly, what rate of inheritance tax would apply to a potentially exempt transfer made within 7 years of the donor's death? Well, the answer to this in our notes is 40%. However, if you've been particularly pedantic, why might you argue, like Marta says, could it also be 0%? So you may have a pet that's made within 7 years of the donor's death, and actually it is taxed at 0%. Why would that be? I think you're both on the right lines, but what's it called? I think you know it. It's just that's right, nil rate ban. So actually, say for example, we had a scenario where someone gave away £300,000 and then died 3 years later, leaving an estate of £1 million, say. We would have to use the nil rate ban against the earliest transaction, which would be the pet of £300,000. So actually, that pet would be taxed at 0%, leaving £25,000 of the nil rate ban left for the death estate. So we always use the nil rate ban on the earliest transaction within that 7-year window. So the question says 40%. But I mean, you can make, well, this is a valid point that it could also be 0%. Yeah. What do we think as regards not is 40% on inheritance tax a criminal amount, but in terms of the exam with regards to inheritance tax? That is it. Really? Yeah, there's so little calculations in it. Yeah, but there's lots of, and it's all automatically marked. So again, there's no negative marking. So if you've got a true false thing, you've got a 50-50 chance. And with something like this, you can hopefully use a bit of process of elimination to narrow your odds down. Yeah, it's so much easier than on AAT 2016, where you've got one question a bit like this, and then you've got another where you have to calculate like death tax or lifetime tax on something going into trust. You could potentially have a pet in a estate, and you've got to work out the death tax on a pet after a taper relief, and then what's left of nil rate band would then go against the death estate and the 40% on that. It can be very tricky. But from what we've seen so far on, students have done really well in inheritance tax. In fact, they've done really well in personal tax generally. Cool. And that is a whole AAT mock over 4 evenings. any questions on anything to do with personal tax? Because this is our last session for our last revision class. I'll be starting our live business tax classes soon. But like I say, it's not a unit where students struggle or anything like that. If you do the mocks, do the work, you pass the exam. It is as simple as that. So, for example, benefit kind of a car, it's going to be there. Tax comp, it's going to be there. Share pool, it's going to be there. It's not something where they just pull up something obscure from the course notes and it's worth loads of marks. Cool. I'll give you a couple more minutes for any last minute questions, but if not, good luck for those sitting exams, especially those sitting tomorrow. Let us know how you do, and I will no doubt see you in some revision class, Facebook Live, student open day or something down the line. But good luck, practice your exams, can't go wrong. Brilliant. Thank you. Good night, everyone.